As promised in my previous video, I was going to discuss Martin Armstrong's 78-year cycle wave or 26-year contraction cycle in the property market globally. You may think it's a very long cycle. Well, it is a long cycle. You'll have pundits talk about property going up or down. Most people spruiking property, especially the businesses that profit from it, which is basically everyone, banks, real estate agents. Then you get the government with all their taxes, stamp duties. Of course, they want to see property keep going up and up and up, but that's just impossible. What can't go up forever will not go up forever. So Martin Armstrong, his website, which again I strongly recommend that everybody follows by just going to armstrongeconomics.com and subscribing. As soon as there's a new article, you'll get an email, and he writes multiple articles every day on economics, investments, finance, politics, property as well. So going back to property, his article from July last year says the bounce in real estate into 2015 that our models projected was for the higher end, not the lower end, as was the case in 2007. So far, everything seems to be on the target. The overall long-term decline will be impacted by the reduction in long-term mortgages combined with insane increases in property taxes as governments try to stay afloat. Okay, before we get to the actual chart, let's go to the next article that he was basically answering readers' question. He does that a lot. This is where he talks about where property can go down, has gone down in the history, not just not the recent history, except 2007. That didn't happen in Australia, New Zealand, and Asian countries. So in this article, he goes to say our problem is what Rome faced. The greater the economic turmoil in government, the more aggressive they become in taxation. In this regard, real estate is not a movable asset, and it can cross the bell curve and decline due to taxation and the lack of mobility. Romans just began to walk away from their property. This is amazing. This chart is the population of Rome from 3000 BC to 1900. As you can see from this chart, somewhere around 200 to 300 AD, the population of Rome was 1.4, over 1.4 million people, and then it dropped down to only 15,000, because again, as he says it, it's not a movable asset. Government knows you own it. Government knows how much it's worth. It's going to tax the crap out of it, and there's not much you can do about it. You might say, well, at that stage I'm going to sell it. The problem is you're not going to be alone. Everyone's going to want to sell it, and what happens to the price when everyone wants to sell it? Obviously goes down. So going to the main chart that I believe Martin Armstrong drew years and years ago when he was in prison. Look it up. He was stitched up by the government because they asked him to provide his algorithm, his predictive computer. He wouldn't do it, so they put him in jail behind bars for about 7 or 9 years, I'm not sure. So the real estate business cycle basically says that from the 1955 it was an uptrend. It was an escalating trend that ended and peaked in 2007. I mean, again, he wrote this at least 10 years ago, and he predicted that 2007 was going to be the peak. So in most countries that was the peak. So as you can probably recall, because this is a recent history, it's dropped down hard, especially in the United States, and by about 2012 it just started to recover. This is where we are now. Just up until about now it kept going up, and we thought, well, this is it. Well, everybody thought that this is it. It's coming back up, and that's exactly what he predicted. So 2015, the next trend is the 26E contraction. So this is it. Now, just to see where this diagram is coming from, we're just going to go to the trusty Google and say I'm just going to Google Armstrong Economics Property PDF, and it's the first result. Pardon my spelling. It's a PDF that he actually produced. As you can see how roughly produced it is. He produced it while he was in jail. And that's where that diagram comes from. This is dated 2009, and that's where it comes from. The full PDF goes into detail. Is all about capital movements. The capital will go from one asset class to another asset class depending on what's happening in the world, depending on what the government's doing, depending if there's a war, and that sort of stuff. So look it up. Google's your friend. Not looking good for property. I would definitely not buy it. Stand by. It'll take a little while until it dissipates, until it completely pulls back. Another reason why property is going to pull back is that it's based off of high credit. So if it was something that people bought for cash and something that people paid off by now, most people, then it probably wouldn't be a problem because people who paid it off will hold on to it. However, if you're paying off the mortgage and the interest rates go up, you lose your job, what are you going to do? You won't be able to service your loan. Another thing is, why has property already started to go down? The interest rate hasn't gone up. The unemployment is steady. If not, employment is improving. That's what they tell us, the official figures. In Australia, I'm pretty sure in New Zealand, in the United States, they're also saying that, the economy is recovering, the unemployment figures are improving. So why is the property pulling back? I mean, there's nothing that actually happened. The oil prices are going down, so there's more money in our pockets. Why is it going down? What's going to happen with any one of those markers start going up? When oil maybe goes up, when people start losing their jobs, when interest rates go up, what's going to happen? I mean, it's a no-brainer. Stay away from property. Thanks.